set up the Cayman Island company, sell at a very high price to the Cayman Island company, and then drop the price down and sell to your customers. That would be the move. But we can't do that because of transfer pricing. Sometimes people don't even realize they have an intercompany pricing issue until it's explained to them.
What is the national sport in the US? And it's not baseball or football, but it's taking each other one to court. My biggest exposure will be that the tariffs will be applied on the retail price, not on the cost or something else, because that can change the whole kind of like the whole thing. That's like whether we make this business even viable or not.
You're seeing it in real time where people are structuring their transactions to avoid the tariff. And some people are doing it better than others. You could be selling into the US and everything's good, and then all of a sudden you get hit with a 50% tariff. That could ruin your business within a couple months. Welcome to another episode of Talking Expat Taxes. My name is Alex McGowin with McGowin Tax, where we help individuals and small businesses find practical international tax solutions to whatever issue and circumstance they have going on. Today I have a very special guest, Eran Shif. You know, what really drove this conversation, I'll let him introduce himself in more detail in a second, but you know, I've been getting a lot of questions around, especially on the inbound side, non-US people investing into the US. And there's always been a standard way or some standard ways of structuring those types of investments, both from a tax perspective and then, of course, the transfer pricing comes into that as well. But tariffs have changed this in a way that now, because of tariff situations, it's changing the way the way we structure things, and that's also affecting the pricing and the intercompany transactions, of course. But yeah, that's where Eran comes in. He and I had a really good conversation the other day about a potential client, and I was going to get him to jump on the podcast and talk a little bit about transfer pricing, about the structuring, and some tariff implications as well. So Eran, give us a little background into what you've been doing, some of your professional background and your current business.
Sure. Thank you so much, Alex. So I'm a CPA and also with some experience in the tax authority. Spent many years in Ernst & Young in the international tax and transfer pricing team. Also like a few years in a law firm in New York, also doing consulting of international tax and transfer pricing. A few years ago, I had an idea to automate part of the documentation that corporates need to prepare to meet the compliance of transfer pricing. With that idea, I hooked up with Avalara, and we built a tax software product that automates the preparation of transfer pricing. From here and there, I left Avalara a couple of years ago, and also incorporated Incodocs, which kind of use the same I would say universe of helping multinationals. Not only the compliance part, but also take it to the strategy, what we need to do when we just establishing an entity, establishing a company. So if you think about a timeline from day one, we're just establishing our US entity, and then afterwards also the compliance. And so in taking into account also technology that basically can help to reduce cost, time, and errors. Preparing compliance and strategy.
Yeah, and let's talk about that a little bit. I mean, from a transfer pricing perspective, I work with a lot of people with intercompany transactions, and sometimes people don't even realize they have an intercompany pricing issue until it's explained to them. But basically, I guess give us just an overview of what transfer pricing is, who it relates to, and what the general issue and strategy is around it.
Sure. So really the bottom line is each tax authority want to make sure they have their own fair share in the pie, meaning that the profits in each country are what we call arm's length and arm's length. So in order to go to this thing, basically the idea is to have what we call comparable companies or comparable transactions. And basically we say, hey, these are comparable companies to our US entity. They tend to earn between X, Y, Z profit margin, meaning if our US entity will also earn something in that range, means that it's check the box, we are at arm's length. So basically that shift of profits. And so this is one important thing. I would even say maybe zoom out for a second. And in the world of tax, basically we have two categories of tax. We have the income tax. It's basically also related more to transfer pricing. And income tax is basically revenues minus expenses, profit, taxable income, what we pay by the end of the year, our tax return. We have another category which is called indirect tax, which is more related to the actual transactions. It's sales tax, VAT, and tariffs. And it's kind of like, and imagine again, I'm a US entity, US subsidiary of a foreign company. We're purchasing some product to resell it. And I think that will be interesting to discuss, kind of to see the different ways how the same literally transaction, how it reflected in indirect tax, i.e. tariffs, and now it's like kind of like what's the aftermath and how it will look like in the end of the day in our taxable, in our
income tax side. Yeah, I mean, at the end of the day, it's really valuation at the end of the day, right? I mean, because from a transfer pricing perspective, you're looking, or from an income tax perspective, I guess more specifically, the transfer pricing comes in when you have one person or one taxpayer that's in control of two different businesses. And if those businesses are in different jurisdictions and they're transacting with each other, you have to be doing it at arm's length. And the only way to find arm's length is to value that transaction as it would have happened in the regular market to third parties. You can't manufacture a price between two related parties because obviously you would very easily be able to avoid tax, right? Set up the Cayman Island company, sell at a very high price to the Cayman Island company, and then drop the price down and sell to your customers. That would be the move. But we can't do that because of transfer pricing. And on the indirect tax side, it's a different concept, but it's still valuation because the way they come up with things like tariffs and customs duties are based on the value of that product coming in. But yes. I guess tell me where I'm wrong there because I think
that's the way. I think let's use even like a use case. So let's say I'm a non-US brand and I'm manufacturing something and I'm selling it into the US. Now, to begin with, I don't need to have a US entity to sell my products, whatever. Let's say I'm in the UK and sell it into the US, right? I can use like third parties, Amazon, FedEx. The whole supply chain can be managed without having any entity in the US. But what we see, and I think that kind of like if you look at the businesses, and I'm not talking about like someone, amateurs are doing, maybe selling on Amazon FBA, $10,000 a year, but let's really talk about some more established business, I would say $500,000 and above, that already it's more established businesses. There are some, and again, not even tax related, a lot of benefits to operate within a US entity, right? For example, for business-wise, it's kind of like you have like a US front, US address, kind of like increases trust among US customers. And another thing, and I always tell it to my non-US clients, that what is the national sport in the US? And it's not baseball or football, but it's taking each other one to court. So another way to manage that exposure is by having a US entity, which kind of like a legal buffer, because the US customer interact with the US entity, not with the main company, which is outside of the US. So that's like a huge kind of like really benefit of having a company, having a company in the US.
Right.
Lastly, and kind of like we mentioned that before, what happened in the last few months, we had a huge thing of the tariffs, and that created uncertainties among those non-US manufacturers that sell into the US, how to manage it. Affect price, cost, suddenly like the competition is in a different way, reduces profitability significantly. And we found a way that having a US entity can literally, in addition to those, to the two benefits I said before, you can utilize this US entity in order to better manage and reduce the impact of tariffs. So we cannot avoid tariffs.
Right.
However, there is, and this is a thing that what we discussed here also, it's about how can we have a control over the price that our US entity purchases the products, and basically that kind of in that manner we can manage the impact of the tariffs.
Yeah, I mean, so I'm going to give an example here, I guess, related to e-commerce. And of course, this concept applies to different types of businesses, not just e-commerce. But over the last several years, foreign investment into the U.S. in the e-commerce space has been huge. I do a lot of that type of work, helping non-resident people get LLCs set up, sell through Amazon, do their U.S. taxes, and there's a whole industry out there of people that do just that work and pump out these returns. But the general I guess the way it has been is the general tax strategy is set up a US LLC. It's going to be a disregarded entity owned by a non-US person. That disregarded entity, all it's doing is it's not holding inventory. It's using, say, Amazon FBA, whatever it is. And so it may have US sourced income because of the title passage rule. But in that scenario, the argument is there's no US trader business because there's no physical presence here, no agency relationship really, because there's no office, no people. Mm-hmm. So that's a huge business right now in the US. And so what I do as an accountant is I file the annual 1120 DE with the 5472 showing the transactions or just the transactions between the US LLC and the foreign person, but there's no income or expenses to report in the US. So generally, that's a great deal, right? Is foreign person, wherever they're from, maybe they're in a non-tax jurisdiction, maybe they're in Costa Rica where they have a territorial system, so it's not taxable in Costa Rica. So that's a great deal for these people. But I think the game has changed a little bit, and that's where...
Exactly. So, and remember, we have those two tax kind of like factors, the indirect and the direct tax, right? So
right, and to be fair, and that's where this conversation started, was I'm not personally, I don't know a whole lot about tariffs. I mean, I read the newspaper, but I'm not a tariff expert. And I mean, you don't claim to be a tariff expert either, but you understand how the pricing affects it. And I'm starting to, but I think that's where a lot of people are missing out. You go online and there's companies out there like Dula and these different places where you can pay a couple $100 and get a 5472 and an LLC and sell through Amazon, you're good. But you're missing this whole piece of the picture, which is the indirect tax.
I think exactly it's the exposure. So I'll do the disregarded entity. I'm great with the income tax. It's typically associated with low operational expenses. It's not so expensive. No tax in the US. Everything goes back to the foreign entity. However, what's the exposure from the tariffs perspective? And if I'm an e-commerce seller, non-US seller, my biggest exposure will be that the tariffs will be applied on the retail price, not on the cost or something else, because that can change the whole the whole thing. That's whether it make this business even viable or not. And that's the exposure that any e-commerce seller needs to consider. Okay, that's my exposure. How do I manage it?
And let's talk, just to nail down that example, let's talk about our friend, the guy in Canada, who is selling a retail product here in the US.
Yeah.
I forget, what was he paying on the tariff on the product he was selling through the US?
So these those are the process, and basically what he was impacted. I don't remember, it doesn't matter the retail price, I don't recall by heart the exact tariff rate, but he was paying those tariffs on the retail price, whatever the end customer in the US.
And I think it was 50%. So he sold wetsuits or something like that. And so if the wetsuit, costs $1,000, he's having to pay a 50% or something tariff, and he's eating that because they're using the retail price of that.
Exactly. So let's link it.
Problem.
Exactly.
So we got a great tax answer, right? The income tax. He's not having to pick that income up in the U.S. That's great, but you have $1,000 profit crossing the border for tariff purposes.
Exactly. So we define what's the exposure. That's the exposure. What do I need to do in order to reduce that exposure? And what we saw is that disregarded entity doesn't really help us. And the reason is that the CBP, the tariff, the agency, can basically, they want to see a real look and feel of a real transaction as if it's an unrelated distributor, wholesaler that purchased the company, right? So it means that all the risks of a FOB, CIF, all those stuff that, we're taking title over the inventory before it enters the US. We want to see repurchase orders from the clients to the entity. We want to see purchase orders from the US entity to the foreign entity. Look and feel as if it's a third-party distributor. And if we don't have this bona fide, feel of it's a real thing, basically we provide a roadmap to the CBP to say to ignore this, whatever you decide that cost, whatever, and imply the tariffs on the retail price because it's kind of like a pass-through entity.
Right.
We can avoid that and look at the final price of the customers. So
what you're
yes.
So what you're saying is you can, if you have the flow-through model, obviously it's going to benefit you to use the cost or something close to it as opposed to the retail price when it's coming across the border for the tariff.
Exactly.
But you have to be able to prove that. And it'd be interesting to know, and I doubt you know the answer to this, I definitely don't, but like what would most people be using, in that scenario? Like, are they using cost and just hoping they don't get caught? Are they using value? Are they going somewhere in between?
That's the question.
But,
that's the question.
I mean, because there was a great article in the Wall Street Journal, I think it was yesterday, where I think the headline said something like, why the tariff impact hasn't had as big of an impact on inflation as everybody projected. And of course, one reason is just that everybody likes to freak out and scare people in the first place. But also, one of the reasons they said was that people aren't actually paying the tariff price that they were expecting. So either they're using different prices or managing that price better. They're going through countries that have better tariffs. So, I mean, you're seeing it in real time where people are structuring their transactions to avoid the tariff. And some people are doing it better than others. And I think that's what this conversation is how do we structure it so it's actually supportable and not just putting a number on a piece of paper. And that's where the disregarded entity may be a problem.
So someone is paying. The question is who, whether it's the end client, the entity, the manufacturer, the e-commerce, the e-seller, but someone is taking kind of like this cost on their behalf or split it somehow. And I think that really to find the right kind of balance, what should be the invoice price? So we set up a company, US entity. It's our importer of record. They're legally or financially invoicing, they're purchasing the product from the Canadian entity, and they're reselling it to the end customers. Now, and we have also here a few options. What should be the price that our US entity will purchase those products from the Canadian entity? And also here, think about it on a scale. So we can be very more aggressive. If we're going to use cost, pass through the same cost, etc. But I think that this is kind of can be sometimes too aggressive because again, CBP will say, I mean, to me, there's no scenario.
To me, there's no scenario where you can justify cost.
Exactly. It's too aggressive. It's and I think that a best way to be kind of a little bit one notch above the cost. So we don't have to be, I would say, full and have a full price. Of course not. On the other hand, we don't want to be too aggressive on being the cost. But if we can find kind of a cost plus something or a different way, I'll take a different way that will be not on the edge, but close to the edge, but not on the edge. I think that can kind of a win-win situation because we're not at cost. We are have something of a more reasonable price, but on the other end, we are still very far from the retail price, kind of that we don't want to be there. And I think that can be a smart way, kind of to manage the price. Now there's some couple of ways how to determine the price. One of them is cost plus, and then basically, so what should be the plus? And how come you came up to this plus? And now we basically are touching down how the CBP also looks at things. And basically we want to show similar products or similar sales, similar invoices to what we did with different entities. And
comparables.
One of the ways that we found, and we're using it more and more now because it makes so much sense. When our Canadian entity established a US entity, the US entity is like a wholesaler. So they sell for the whole US market. From a separate entity, from the Canadian perspective, this US entity, I think it is the largest clients of the Canadian entity. We sell to Singapore, we sell to UK, we also sell to the US, a single client in the US, which happened to be our US entity. So the US entity kind of from the Canadian perspective, it's the largest client, right? Because they can cover the whole U.S. market. Does it make sense?
So you're going to give a good price to your largest client, right?
Exactly. So we're talking even inside in the same group. Would you give reasonably a good price, a discount for your biggest client that purchase products X10, X11, then your second biggest client, that's of course yes. The only question is like to determine how much it is. And one of the, because, and it's hard to find real comparables. No, we don't have any other clients that also purchase for $1 million a year. We have some few, like someone says maybe for 50K, maybe someone 75K, yeah, and we provide them 50%, and maybe someone we provide another 60% discount. What we are doing, we are taking those kind of like examples and basically using mathematical statistical formula to logically estimate what should be the discount rate for US companies that whatever, let's say sells $1 million a year. Mm-hmm. And by that, kind of like, we don't have a real comparable exactly clients that also purchase $1 million a year, but we provide a logical way to have a logical estimation what should be the price, what should be the discount rate for a large client that whatever, let's say purchase $1 million a year, where our second largest client only purchased whatever $50,000 a year, and for them we provided whatever 30% discount, and we had another client to whom we sold $100,000 a year, and to whom we provided 65% discount rate. So we're taking those 2 points and basically extrapolate and kind of like come up with the rational, logical rate that can be executed on our US entity.
Yeah, no, that makes sense. Do you know, does the CBP, I mean, do they have a similar like auditing process like the IRS would, or who is the actual authority that's auditing that sort of thing?
No,
or does
CBP.
Does the IRS do?
Similar
CBP
IRS, CBP. They have a method similar like the IRS, not exact methods, but they have like certain method to evaluate what should be the price. And again, naturally they're looking at the invoice. They want to see similar products or identical products, or if not similar.
So you can use the same documentation for income tax as you can for like a comparable analysis. I mean, obviously, income tax has very specific rules.
Exactly. So it's like let's do like a fast forward. Perfect, Eran, okay, we're using 80% discount rate with a US entity. We're purchasing the products really cheap, right, from for Canada, and we're selling into the US. Now, all the expenses are, what will happen, like let's do like a fast forward towards the end of the year. What happens now? Our US entity, super profitable, right? All the income, all revenues from US customers are in the US entity. We purchase the product super cheap, because we got a discount of a wholesaler. And yeah, we have some operational expenses, mainly logistic expenses, and maybe some minimal kind of like, admin compliance expenses. All our profit, or most of the profits that we derive in the US market, is now within the US entity. Now let's go now in the income tax, now we need to file our tax return, like we have a huge profit in the US. And here comes the transfer pricing for income tax. And it's a bit different than how CBP looks at pricing. CBP looks at the actual invoice, the actual product, while for transfer pricing, income tax perspective, it's a more broader review. And basically, we're looking at the functions, risks, and assets that each entity employed. Imagine like a table. We have US subsidiary on one side, and the other side, the Canadian entity. And kind of like we ask ourselves, or the tax authorities ask themselves, which entity respond, what are the functions, risks, and assets in each entity. And now our US entity almost have nothing. We don't have any employees. We don't even have an office, right? But so most of the functions are in Canada. Most of the risks and kind of like also the people that can make decisions over the risk of their business are in Canada. The intellectual property, brand name or kind of a know-how is owned by the foreign entity. So basically what we have, if you look at the table, we have everything almost in the foreign entity, and it's a very limited, kind of like what we call limited risk entity in the US. As a limited risk entity, basically, it shouldn't have earned too much money, too much profit, because you take limited risk. So what we're doing, we're benchmarking the US entity to other limited risk distributors, and then just like saying let's say really like about, let's say between 2% to 5% operating profit margin, which is very close to the taxable income. It's like the profit before tax and interest as a percentage of the revenues. So whatever we sold in the US, let's say 2-3%, that will be our profitable, almost our taxable income in the US. But before that, we're much more profitable than that because we purchased the product for really cheap. And what we're doing, or the company is doing what we call intercompany balances. Typically, every quarter or before year end, intercompany balances to align the profit of a US entity to align with the 2 or 3% that we determine. Now, those intercompany balances on what? Basically, they represent all kind of like, let's call it all the functions, the services, everything that the Canadian company provided to the US. Well, the strategy, the management, the brand, the strategic, alliances that we have with other partners. So you have basically you have the whole village behind you in order to make this sale to the end customer in the US. And basically for that, those intercompany balances, those intercompany charges are on that behalf. Now there's someone to say there's no, in those intercompany charges, no inventory, no goods are going from Canada or other to US. It's in the books, behind the scenes, kind of like that, only to make those adjustments. So summarize it for a second. If you take this A to Z, we purchase the products in a lower price as a wholesaler, pay the tariffs as a wholesaler. By the end of the year, we're doing those intercompany adjustments, balances, kind of like to align with the functions, risks, and assets, same as we have in those comparable companies. So our income tax in the US will be according in the same manner with whatever, with a 2 or 3%
transfer price was.
And that's the transfer pricing.
So so they're really two different things. We're coming up with a value of the product for indirect tax purposes, whereas in the US, we're coming up with a comparable profit margin. So if you look at the sales line of the tax return, it might not be the same as if you added up all the value of the product coming over from an indirect tax perspective. And that's okay because it's not the same calculation.
Exactly. It's not the same perspective. It's like CBP doesn't take risks. And
they're not going to ask for your Section 482 income tax return documentation. They don't care about that.
Exactly.
They want to know.
So,
it could be part of it, but not really.
It's important to say that also. It's like two things. First of all, there's never bulletproof. It's like we are in the tax world, so nothing is bulletproof, and any agent can challenge and decide, and no, I don't agree, blah blah blah. So it's important to say. And I think maybe more kind of like even more mature way to look at it. It's risk management, right? Yes. As an entrepreneur, as a reseller, as an e-commerce, when you manage a lot of risks, you also manage to this risk. And one of just what we are offering, kind of like the A to Z, it's a great way to manage this exposure by having this strategy and having kind of also the document that supports that, right? It's not like we decided like that to have an intercompany agreement, to have like a kind of guidance memo that tells about the transfer pricing for income tax, to have the calculation, how we came up to the appraisal of the invoice, of the wholesaler discount. When you have all those things aligned, kind of like, again, it's never bulletproof. However, you will be in a much better, stronger tax position because you have the documents that you did like in a bona fide and before the time also prepared in advance. That will make, you'll be in a much better, stronger position if you don't have those things.
I mean, my takeaway from this conversation is really that I think there's a way you can have the best of both worlds, right? Like we could set up a disregarded entity in the US, in which case the income tax transfer pricing is irrelevant as long as we have a solid argument and a defensible argument that there's no US trade or business. But we can still call it a limited risk distributor for purposes of the indirect tax world.
I think that the disregarded entity, the thing that I don't like with the disregarded entity is that because it weakens, I think, all the thing with the CBP. So kind of like my advice, if I have to, it's like set up an LLC but as a C Corp, right? Tax as a C Corp or a C Corp. I would not. I don't like that. I think it's too risky to have a disregarded entity.
Right. I mean, it takes some of the substance away. You're calling it a limited risk
That's like
distributor, but it's not really doing anything. anything. I understand.
Again, going back to the exposure, that's what the biggest exposure that will be tariffs will be imposed on the consumer side. And
then it's a question of comparing. It's a question of comparing the disregarded entity model to the C corp model and managing that risk and exposure. Because, like, to me, one of the problems I've always had with the disregarded entity model is ultimately selling the company. So if people set up these U.S. LLCs and build a business around it, and then they want to sell the stock of that company or whatever, or the assets, the way that the U.S. income tax rules work is it's sourced intangible property, which would be the goodwill of this business, or the intangible asset of this business, is going to be sourced based on where the product was used and created, which it's going to be hard to argue if that wasn't in the U.S. So now if you haven't been establishing a transfer pricing set up with a C corporation all along, it can be tricky to say, okay, the last 10 years we reported no income in the U.S., but now we have to come up with a value related to the sale of this business in the U.S. Whereas if you did the C corp option, you can kind of set that up on the front end and manage that U.S. income tax exposure through transfer pricing in this limited risk distributed model from the very beginning. I mean,
if I put myself as an entrepreneur now, or a seller in the US, I get it, pros and cons, corporate versus disregarded entity. I think that one of my key questions will be, and I don't know this, what's the cost? What's kind of like the startup cost to have a disregarded versus C corp?
Yeah.
And what are the annual costs that I need to take into account?
Mm-hmm. Yeah.
I think that right? It's like,
for sure, that's part of this analysis. And I think that's what, if you're talking to an accountant, I think that's where people need to be a little bit careful with these online systems that are just like spitting out these disregarded entities and 5472s, because they're giving you no real advice. They're just charging you $500 to get everything set up and roll with it. But you don't really know what's going on behind the scenes there if you're really getting the best situation. But you need somebody to show you a real comparison. Like, this is the cost of operating a C corporation and the potential tax. This is the cost of operating in the tax of a disregarded entity. And then you have to layer in the indirect tax. I mean, it's not that simple at the end of the day. You can make it simple and cover your eyes and pretend everything's going to be fine and nobody's going to look at something. But yeah, do you want to cover your eyes, or do you want to go into it with your eyes open? I think that's a big part of it.
So it's like really kind of like insurance or something else. So kind of like, there is a cost, I guess. Again, I don't know, but I think there is more cost to have a C corp versus a
for sure.
Entity. For sure, we have much more. It's I don't know for how much. There is more cost for that, but again, what's the difference in the cost? Is it like really material, yes or no? And that really depends on each business and each.
It's going to depend on the operator. And how many states are there? And there's a lot of options.
And I think that we kind of mentioned it like before. It's really related, I think, to the magnitude of volume that you have sales in the US, right? So if I'm selling $50,000 a year, $30,000 a year, kind of like I'm still ramping up, I don't know, but I think once it's becoming like a more robust kind of like features of a real business, and I'm just like naming whether $300,000 a year or $500,000 a year, I think kind of like when you make this decision, it makes more sense because your exposures are bigger, right? You want like, you will be more chances will be on the radar. The volumes that you have more exposures to manage, kind of yet the difference in the expenses, it's a bit more expensive to have a C corporation. But again, for a company that sells $1 million a year, maybe additional, whatever, $400 a month, it's not the end of the world, right? And you compare it versus all the benefits that you have, exposure, reducing the tariff exposure, and kind of like exit strategy or partner strategies that will be in the future. I think kind of like that's a decision that everyone, but it makes more sense that kind of like to tend to do things once you are a bit kind of like more of a business in terms of volume.
Yeah, definitely. Yeah, well, look, I mean, I think this is a concept that gets overlooked a lot, and I think that there's a big opportunity for people, to manage risk and exposure. And I guess you could look at it either way. You could look at it from the perspective of someone that's taking unnecessary risk that they're not documenting and supporting with proper transfer pricing and structuring. But you could also look at it from the perspective of people who are just selling things at retail, through the U.S. and getting hammered by tariffs that don't necessarily have to, So, I think there's opportunity and risk, and you're balancing the two. And yeah, I think that's the opportunity.
Also about the retail, something also important to mention. So in the US, we used to have like a de minimis rule. So values, again, I think under $800 were not under the tariffs, and that changed. So basically also like any product today is subject to those tariffs. And again, this is what we both of us kind of like feeling kind of in the last month, the amount of emails, calls, discussions that we had with non-US brands that are selling into the US. Everybody's impacted from that.
Yeah.
And kind of, I think
it shows how quickly things can change, and you need to be prepared for that. You could be selling into the US and everything's good, and then all of a sudden you get hit with a 50% tariff. That could ruin your business within a couple months. A 50% tariff. Or sooner. So having the structure in place, yes, it's managing risk from an audit perspective, but it's also managing risk from a governmental change. I don't know what the word is, but change in policy.
Alex, it literally saves money, right? Because instead of paying $100 per unit, you can do it now, let's say, $20 per unit, right? So it's like real cash savings of tariffs that will be paid again.
Yeah.
So that's basically.
We're definitely going to be dealing with tariffs for at least a couple more years, no doubt. Trump likes that lever that we have on the tariff side.
and even with the tariffs, something about like any business, we don't like as business owners, we don't like uncertainties, right? I'm a business, I'm selling, I want to know the certainty, and uncertainties can like disrupt business. And because of these uncertainties, again, having this US entity, you have at least a control over the actual price that you're purchasing and the impact. So, and I think
it gives you some control back over just like these uncertain.
That's a lot of value.
Economic influences.
100%.
Well, look, this was awesome. This is a great information, I think, to have out there into the world. If people need to get in touch with you, or if they have questions, what's the best way to reach out to you?
Google just Incodocs. I guess it will be.
I'll put your information in the show notes too, so people can reach out to you. And okay. Well, hey, it was great having you on. This was a very interesting conversation. It's a moving target to some extent, but I think the whole point is, be prepared. Don't just assume. 100%. Don't just assume one way or the other. Get real advice. Be prepared, and
And I think that also last thing, can I just wrap it up? Like I said, so again, I'm putting myself as an entrepreneur or someone, a seller that's selling into the US. Because of technology and what I also specifically, again, I told about everybody else, but also with the technologies that I'm using, we can wrap all those documents that you need and to make it not as expensive as you may think. And honestly, it's something that can be very, very competitive price. Again, because I'm using this technology that can help produce those documents in a much more, I would say, competitive price.
Yeah, that makes sense. All right, cool. Well, great talking to you, Eran.
Thank you so much. It was great talking with you.
We'll talk to you later. Thanks for coming on.
Bye-bye.